Okay, we'll get started in 1 minute. So nearly ready. Okay, well, it's 8:05. Thank you very much for taking time out of your busy schedules to join myself. My name's Richard Lowe, and my co-host tonight, Frank Cartwright from Yield Investing. And just to give you the heads up on the roadmap for today, first of all, I'm just going to do 10-15 minutes as a quick overview to the UK property market. It's been quite a roller coaster in the last 12 months. Some of the macroeconomics that are driving the industry in the UK. The presentation, though, will be with Frank, and he's going to be introducing yield investing and what UK social housing is all about. For many people in this part of the world, it is a new and exciting asset class. And for those people really looking for a low risk but high yielding property, there really is very little that I think can match this. So Frank's going to be presenting about that. Now, for anybody who'd like to ask questions, we always encourage it. There is a chat box, and you should be able to see that towards the bottom right-hand corner of the screen. Please do put questions in there. What we'll do is, just so we don't sort of ruin the flow of the presentation tonight, we'll take the questions at the end, but you're more than welcome to put those questions into the chat box if you feel appropriate. We might cover it later on, but that's the roadmap for today. So without further ado, let me get started, and let's just look at some of the things that have been influencing the UK property market over the last 12 months or so. So many of the people on the call today are from Singapore. We've got lots of friends also coming in from Malaysia and a few scattered from other countries around Asia. But I've lived in Singapore for 27 years. And in fact, this is now my 28th year. When I first arrived in July 95, the exchange rate between the Sing dollar and the pound sterling was at 2.6 Singapore dollars to the pound sterling. I remember selling a property in the UK back in 2007 when it was 3.15 Singapore dollars to the pound. Today's exchange rate, as you can see at the top right, is 1.6, or just over 1.6, which is a drop of about 50% since 2007. And even since the referendum for Brexit, when there was a sharp drop back in about 2015, 2016, we can see about a 20-25% difference in the exchange rate. So the bottom line is that for callers who are living and earning in Singapore dollars, the exchange rate is absolutely phenomenal. And it's almost like getting anywhere from a 20 to 50% discount, depending on when you benchmark the exchange rate. If we compare with one of the other major currencies, the US dollar, similar kind of story. The US dollar has been extremely strong recently, albeit it has weakened a little bit in the month of February. But as probably the main currency around the world, if people are holding US dollars, again, potentially a very good time to invest into a UK pound sterling asset class. Now, one of the major drivers of any industry is supply and demand, and the real estate industry is no different. And here we've got a graph that goes back to the year 2000 that is showing the number of new dwellings, whether that's in the resale market or whether it's from developers bringing new stock into the market, of showing how many units are coming onto the market each year. Now, the UK government estimates in order just to keep up with demand, the UK needs to be delivering 300,000 units per year. And if you look at this graph, in no one year over the last 20 plus years has the UK been able to achieve that. And so as a result, the UK has a chronic undersupply of residential property, which continues to drive up prices, makes it a very good asset class to invest in as part of an overall investment portfolio. But it does present challenges, particularly to first-time buyers, because prices continue to go up, and it makes property acquisition and getting onto the ladder more and more challenging. So this graph here is actually showing the average price of a property across the UK. And so if we go back to January 2005 at the bottom left of the line graph, we can see that the average price of a property was about £150,000. Coming up to recent times, that figure is closer now to about £272,000. And if we took the data going back when records began, which was in the 1960s, you would find it's pretty much a straight line in the UK, apart from the odd blip, which in fact is shown on this graph back in 2008 and 2009. We see the biggest blip in a 60-year period of time, which was the global financial crisis. And the UK property market went down by about 18% over the course of a year or so, which again was the biggest drop since records began, but was certainly by no means anything like as bad as any other countries. And we can see that it's fairly quickly recovered. Interestingly enough, as we look to January 2020, as COVID started, the actual line is getting steeper. And in the last couple of years, we've seen almost unprecedented capital growth in the property market. And I chuckle a little bit because I remember the analysts in early 2000, as the COVID pandemic was breaking out, was anticipating somewhere between a 5 to 7.5% decline in property prices. So how wrong can they be? And I kind of make reference to that because I'm going to be showing you a few slides in a moment, which is analyst predictions for property prices looking into the future. And I suppose over the years, although I use them to try and give an indication of what the market will do, invariably, they get it wildly wrong. Now, what we saw back in early part of 2022 was prices were still continuing to rapidly increase. A variety of reasons were causing this during COVID. So several factors contributed to significant property price growth. One was people were really rethinking what they needed from their property. If they were going to be spending significant time either locked up or because of government policies. And so people became far more aware of having space, whether that be in an apartment with an open balcony, communal gardens, or direct access to public park space nearby. The government introduced a stamp duty holiday. Interest rates were at a historic low. And so many people took the opportunity to upgrade the property with the low interest rates, take advantage of the stamp duty holiday. And during the COVID time, there was a slowdown in supply of the market because builders couldn't get on site, planning department staff were on furlough, and it just all added and contributed to the supply-demand deficit, which saw these incredible property price growth. But really, by about the second quarter of last year, the Ukraine war had unfortunately started. Inflation was increasing significantly. And as a result, banks or central banks around the world have been increasing their interest rates as one of the main strategies to try and reduce the inflation. On top of that, cost of living going up, less disposable income. So what we find is that really last year, there's been a change from being a seller's market to much more of a buyer's market at the moment. Now, even though interest rates have gone up, and the base rate now, I believe, just went up again last week to about 4%, more and more banks are now getting back into the market. And with that competition, we've actually started to see some of the banks reducing their interest rate loans. So that's an initial positive sign. But if you have a look at this chart here, this goes back over the last 50 years of the Bank of England base rate. And we can see really in the last 10, 12 years in the green line to the bottom right, unprecedented low interest rates. And my guess is if you are somebody who is 40 years or below on the call tonight, and you've invested in property in the last 10, 15 years, you've only known exceptionally low interest rates, and potentially that's what you think is the norm. I remember 20 plus years ago buying my first property, I was paying something like 7 or 8% interest. But if you go back to 1981, the the base rate was at 17%. Now, that's not including the spread that the banks will put on top of that. So I hope this puts things into context that even though we've seen interest rates rise, and you're probably looking, if you take a UK mortgage at the moment, depending on the bank, whether it's a variable rate or whether it's a fixed rate, you're probably looking at somewhere between 4 to 6% as a non-resident investor. But again, when we look at the last 50 years, 4 to 6% is actually still very much on the low side compared to what the average has been over the last 50 years. Now, this slide, which was produced by One Global Labs, for those of you who don't know, I carry my license with One Global here in Singapore, and they do a great deal of research. And this slide really blew me when I first saw it, because each of these 3 bars is a snapshot of when there was an interest rate hike or an interest rate increase at that point in time. And we've got about 11 snapshots here going back all the way to 1972. And it may be a misconception to believe that when interest rates go up, property prices go down. Well, this data shows the opposite. It shows that actually every time there was an interest rate hike, with only one exception in 1994, there was a slight blip, prices have gone up. And what we see in the black bar is what happened to prices 1 year after the rate hike, the silver bar 2 years after the rate hike, and the brown gold bar 5 years after the rate hike. So it would be a wrong assumption to say just because interest rates have gone up, we are going to see a massive fall in the property market. It's still, I think, early days. We have definitely seen a slowdown in the growth, but there have been some wild predictions of what will happen. And again, it's either analysts or sometimes people trying to grab headline attention through the internet. Now, for those of you who are on the call who are prime central London landlords, you've gone through a real roller coaster in the last couple of years in your rental. What we are finding in prime central London, zones 1 and 2, is that in the early part of COVID, when the lockdowns occurred, people were working from home. People thought, well, I don't really need to be paying top rent and living in prime central London if I don't even have to go to the office anymore. So I might as well cut my lease, find somewhere cheaper and ride out the storm. And we saw a drop of anywhere between 20 to 30% lowering in the rents in London. But in early 2021, when the UK government started to get back to normality, we saw a real V-shape in the rentals, to the point where the actual average rent now is higher than it was pre-COVID. The market is incredibly in short supply, and it's not uncommon for people having to do a viewing to make their mind up on the spot, and sometimes be giving even up to 6 months rent in advance. So there has been a massive rebound in the rental market. So as I mentioned, this is JLL's crystal ball, or what they are predicting for property price growth. Now, this is based on 2022 predictions for the next 5 years. So those predictions were made at the end of 2021. So it was as the UK was really getting out of COVID, but the Ukraine war hadn't started. And so this is why I say we can, to a certain degree, take analysts' predictions with a pinch of salt, because things can happen and things can radically change. So we can see that in this year, in Greater London, for 2023, JLL were predicting a 5.5% capital growth. I think that's going to be quite unrealistic based on what we've seen, particularly because of the Ukraine war, increases in interest rates and inflation and affordability. This actually similar picture, again, 2022. So again, didn't take into account the sudden change in what can happen in the economy. And for these cities in Manchester, Leeds, similar very bullish predictions in the capital growth. Now, this is a prediction that was done at the end of 2022, predicting the 5-year capital growth forecast for the next 5 years. So probably something that is more accurate. And so what we can see is for capital or cumulative growth, JLL are forecasting across the UK prices to drop by 6%, and then from 2024 gradually creeping back. We can see down towards the bottom the cumulative rental growth, which is very healthy at 4% this year and continuing to be very strong in the years to come, just again because there's such a tight supply of property. So if you are a landlord at the moment, you should be seeing hopefully increases in your rent and very little time in terms of void period. So that's just a little snapshot and update of what's been happening in the UK market, really looking at some macroeconomics of what's driving the market at the moment. That's the end of my short part. What I'd like to do now is hand over to Frank, who's going to be sharing more about the company he works with and is a principal of, Yield Investing, and the UK government-backed social housing, and what an incredible investment opportunity it is. So, Frank, over to you.
Thank you, Richard. Good evening, everyone. Thank you for taking the time to participate in this. I know, Richard's been very excited. It's a novel product, maybe something that you've not come across before. My name is Frank. Like Richard said, I'm the co-founder of Yield Investing. Prior to this, I was in Asia for 6 years, working in primary residential markets in the UK, advising high net family office and institutions on where they should advise, very much based on what Richard touched upon about macroeconomic trends and whatnot. And what we were getting more so than anything else was a lot of clients coming to us and saying they didn't want potentially off-plan products. They didn't want something that was 1.5 years, 2 years away. They weren't looking for a variable rate mortgage. They weren't looking for a private sector tenant. They wanted something that was completed, that was going to give them cash flow every month, very low risk. And they wanted a net position of at least 7% net. And so in my due diligence, I came across a good friend of mine who's the co-founder, Nathan, who's my development partner, who was building residential assets. And he was doing something quite unique, as in he was applying commercial leases to these residential assets. So just like an Amazon, a Starbucks, a McDonald's, any kind of commercial sector tenant, he was applying what's called full repairs and insurance contracts to those properties. So as we'll come into in just a moment, that means that the tenant is paying no ground rent, no service charge, no management, no maintenance, and no tenancy turnover for the duration of the lease, with a rental assurance from anywhere for 5 to 10 years. So I actually went through this purchase process myself, purchased a property that was yielding 8.5% net. And I came to the conclusion that this would actually be a fantastic product if I could offer it to my client base. So we went out, raised some money and standardized the investment across 10 to 15 houses. And now we're turning over anywhere from 25 HMOs a month, and we've started including block portfolios into the property sector as well. So Richard, if you just come on to the next one. So essentially what we're doing is we're building and buying our own residential properties. We're bringing them up to the standards of a housing association. So that means full turnkey development from ground up, which is total refurbishment, new windows, doors, kitchens, bath, electrics, gas certificates, you name it, bringing it up to the right EPC kind of regulations. Then we're obtaining a long-term commercial lease. And I think the three major differences that we're talking about in this investment relative to anything else is the rent is actually coming directly from central government. So if you look at social housing as a collective, it makes up 19% of all property in the UK, which is larger than the buy-to-let sector at 17%. And really, all that really means is that the rent is originating from central government to local housing authority to housing associations, which are fully FSA regulated entities which handle tenants and the rental contracts. And you as a landlord is basically taking out a 5 to 10 year contract with that housing association. So number one is you're not relying on private sector, which means that you're not at any kind of risk to what's happening in the wider economy. You're singularly looking after a government tenant. Number two, you're getting a FRI commercial lease from anywhere from 5 to 25 years relative to what would be a normal 12-month AST contract. And finally, I think what's probably our biggest difference is that all of our rents are linked to inflation. So if you go down, Richard, social housing effectively is the government is the tenant, is the landlord. It's looking after individuals who can't effectively house themselves or pay for their own rent. So that can be anywhere from homelessness, domestic abuse, veterans, special needs, you name it, NHS frontline workers. And effectively, all that's being done is they're being handled by housing associations, who are these regulated entities which are taking on the rent. So if you go to the next slide, this is perhaps one of the most important slides. So in 2018, a piece of legislation was passed called the Homelessness Reduction Act, which basically meant that most UK citizens that are at risk of becoming homeless have the right to any kind of accommodation. So you can see what that led to was a huge spending in temporary accommodation. So if you go to your local council and for whatever reason, if we look at COVID, over 70,000 people became homeless in the first lockdown alone. They go to the local housing authority and they say, I need somewhere to stay. Because of what Richard said, the UK property sector is so undersupplied at the moment. He mentioned 300,000 properties per year need to be built relative to what's actually being built at the moment. 125,000 of those are social and affordable, of which last year less than 10,000 were actually built. So the government is being forced to put people up in hotels, Airbnbs, and unsuitable temporary accommodation, which is far more expensive than what the government is willing to pay. Hence why you probably read in the news, in the BBC articles, you've seen that immigration tenants are being put up in these fancy restaurants, these fancy hotels and Airbnbs. So our model essentially is we go to local councils, we go to local housing associations, we say, for example, in one area, you may be spending £75 per night per person to house that person for the week. We then reverse engineer that and say we will charge you £65 per person for the entire week, therefore massively reducing the fiscal deficit of the actual local council and hopefully implementing some sort of deficit on actually, you can see how many people are still on the waiting lists and have been since 1995. Over 1.15 million people for the last 23 years have been on the housing waiting list. So if you just come into the next one, because of really what happened in 2018 and this new law that was passed, in 2019, there was next to no private equity in this sector. There was literally, there was zero private equity from any large institution who were looking to invest in this outside of build to rent and anything else in the sector. If you look now, last year alone, 8 billion was spent from some of the largest institutions in the world, most noticeably Blackstone, Schroders, Morgan Stanley, Goldman Sachs. There's now 3 purpose-built REITs, Home REIT, Triple Point, Civitas, and all they're doing is basically accruing what would be their LP partners, their limited partners, which are pension funds, and accruing social and affordable stock. And that is for the same 3 reasons that we've said today. That the rent is very predictable, it's very secure, and it's regulated from housing associations coming from central government. You're getting a full repairs and insurance lease, meaning completely hands-off management, and the rents are linked to inflation, and that is consumer price index plus 4%. So effectively what you're doing is buying secure rent roll, hence why our name became yield investing. So last year, we aggregated our first large portfolio, over 327 units, to one large private equity company that bought them on a 25-year lease at 6.5% net. And that was a large transaction for them. Last year, we understood that actually this product could be broken up into individual units and sold to retail investors. Why shouldn't our retail investors based all over the world benefit from all the things that a normal institution is doing? And if we just go down again, you'll see the major investment highlights. It's a full turnkey solution, fully refurbished property up to the standards of a housing association. The rental agreement's already in place from day one. There is no risk of ownership. There's no construction delay. It's a 2 to 4 week process, and you're singly buying a property that's up and running with a lease in place. Lara's on the call here, who runs our operations, and I'll just ask her to jump in on a couple of slides just to go over exactly how that works from a purchasing perspective. But But if we just come down into the investment highlights again, Richard, there's no property and lettings, there's no ground rent, there's no service charge, there's no management, there's no maintenance. An FRI lease means that any damages incurred to the property through the duration of the lease is laid responsible to the leaseholder, which is the housing association. Our minimum net yield offering for one of our offerings is 7%, up to 9%. And actually, we've had properties come through at the moment which are a 10% net. And that net is a net figure. There is no gross to net leakage at all with that because of the FRI lease. And the minimum lease that you'll be signing is a 5-year contract. If we just go down again, you can see some of the typical vulnerable adult types that we work with. That'd be homelessness, refugees. In 2019, Mears and Serco won a £3.5 billion government house asylum seekers in the UK, and that's a 10-year lease. We're operating in the Northeast, working with Mears. We've done hundreds of units over the last 18 months with those guys. Fantastic tenants. And again, the leases make it incredibly worthwhile for landlords. If you just look at what our standard availability would be, at the moment, we're ranging anywhere from 80,000 to 150,000. So you can see Salisbury Studios, there's 4 studios, 81,000 each, already generating £6,500 per year, giving an 8% net yield. Structured in a 10-year contract, the renewal date will be in 2023. A 2-bedroom property will be £107,000 a flat. Typically, a 2-bedroom freehold house will be £116,000, a 3-bedroom will be £152,000, and a 4-bedroom will be about £187,000. Now, these are HMO investments on shared room rates, but they're able to achieve fantastic yields. And that, like I said, again, those net yields are those net yields. And a lot of people, if we come down, have a kind of prerequisite for what they actually think the houses are going to look like. It's really important to remember there's low income housing, there's private sector tenants, and then there's housing association tenants. So if low income housing is a tiny fraction of what you'd be able to achieve in the private sector, that would get a certain yield. A private sector tenant would bring you another type of yield, but then you'd be liable for all the costs endured. A housing association tenant might be a higher level support where we're claiming higher rents from local government to look after a tenant, where our rents might on average be 20 to 30% higher than what you're getting on the open market. And because of the type of tenant that we're moving into our properties, they have to be specifically refurbished for the type of support that they require. So if you go down and look at one of our 2-bedroom example, once you've been inside one of our properties, you've been inside all of them. They're all done up to an incredibly good standard. New kitchens, doors, windows, floors, fully furbished. Everything's insulated up to an EPC minimum. You know, it has to have all the gas certificates, electrics. And our refurbishment team are all in-house now, a team of 15 that are handling all that on the ground. You can see on the outside, again, Keswick Street here as the 2-bedroom example. 116,400 for a 2-bedroom property, 9% net yield with an annual rental income of 10,478, and that's net. The only thing that is actually required on that is building insurance, which is about £25 per month. So including service charge, including stamp duty, legal fees, land registry, you're looking at a total estimated cost of purchase for about 120,000. If you go on to our 3-bedroom example, it's just a larger layout with a larger open plan living and dining. Again, once you've been in one of them, you've been in all of them. They're all done to the exact same standard for the housing association. Just go down to the key highlight below. 152,000, 9% net yield, annual rental income net 13,789, 10-year lease, estimated total cost 156. But one thing I would like to point out, and because the rent is actually annualized and it's reviewed every year alongside CPI plus 4%, and that's only reviewed in an upward trajectory. So if we were to presume that we're at 9, 8, 10% inflation rates at the moment, if we assume a 2% inflation rate on a rental review every year for the next 6 years, and that's compounded over 6 years, our net yield actually becomes 9, 9.2, 9.35, 9.5. By the end of the 10-year period, we're more likely to be at 10.4% net yield. And that's singly because of the rental inflation that's actually reviewed every year alongside inflation. So I think the reason why you're seeing a lot of these institutions move into this market and why it is such a popular market for these private equity companies is not only have they been managed to match the acute supply-demand imbalance for social and affordable, but they've actually found a way of managing that acute supply-demand imbalance to access inflationary hedged assets, of which there aren't many things at the moment that we can do to protect ourselves against inflation. Having something that's linked alongside CPI, with the rent deriving from central government, with that net FRI lease, is seen as a very, very secure investment model for them at the moment. And that's really what we've carried over to some of our retail clients. And I think why Richard wanted to show this to you guys today. If we come down to our block, this is a block that we've just acquired in Hanover, in Stockton. This is a 31 unit freehold building plus commercial office on the ground floor. This was an over 55s retirement village. It was run by a housing association called Anchor Housing until it got to a point where it was slightly decrepit and they didn't feel like it was up to standards to manage those tenants. We've come in with a JV partner. We've acquired the block. We've refurbished it all up to housing association standards. It's now rental income generating at 243,452 per annum. And again, that is a 10-year lease. And that's no break clause on either side of the contract as well. So the covenant strength is perceived to be extremely strong. Commercial contracts at the moment are incredibly hard to get. If we actually look at most of the sectors in the UK, we look at residential, commercial, leisure, industrial, and social. Industrial is the only other sector in the market that screams out something that's incredibly solid at the moment. We're seeing the economy come into a potentially part of turbulence with what's going on with inflation rates and interest rates. And it's just one of these sectors where it's a core necessity. Like we said, there's over 1.15 million people on the housing waiting list for this type of property. So I'll leave it with Lara. Lara is our operations manager. She comes from a legal background. She handles all of the purchase process for all of our overseas clients. So I'll just hand over to you, Lara.
Thanks, Frank. Hi, everyone. Like Frank mentioned, I'm responsible for ensuring that all our purchasers have the smoothest process with us when they purchase through Yield. The first step with us is to pick your unit. That will be through the sales team here. You will then pay your reservation fee. Now, this will depend on the size of the unit or whether you've purchased a block or a single unit. We will then either recommend using our solicitor that we usually get our buyers to purchase through, or you can use your own. 9 out of 10 people tend to go with our recommended solicitor due to the fact that they understand that commercial lease, which definitely sort of speeds up the process when purchasing. Once you've done your AML checks, now this will depend on where you're based and how long that will take, you will then have been, instruct your solicitor, and we will then aim for a 2-week turnaround with the process. After this, you will then make the remaining payment for the property, and we will then start to set up buildings insurance and the transfer of the lease. Now, all rental payments are backdated to the day of completion. So yeah, we tend to most of our completions are within 2 weeks. But again, that just depends on AML on when that can be done.
Yeah, just second that all the properties are already income generating and completed. So we're trying to target 2 to 3 week completions. Effectively, this model is brought forward for clients who understand that cash flow is very important. We don't say anything against 25 years mortgage kind of investments based on capital appreciation. One thing that I've learned in 10 years doing this is capital appreciation can be very subjective and it can be a very long-term thing, whereas immediate cash flow from day one is something that you can't argue with. So like I said, every single property that we bring forward will have a 5 to 10 year lease already in place. It will already be refurbished and it'll be ready to be purchased and income generating from day one of ownership. And because they're already up and running, it's our solicitors and everything's going quite quickly. You should be income generating in week 3 or 4, depending on how quick everybody decides to move through legals. So we have a full dedicated team on the ground in the UK that help with the legal process. We have a full dedicated team in the refurbishment team that bring up-to-date photos. We can tell you everything about the tenant. And it's literally just like clockwork. It's when you're buying a different type of property, you might be waiting for an update. This is literally just 12 rent checks a year on the whenever it's backdated, so it just comes and goes like clockwork. So yeah, it's just a high yielding, very low risk, cash-based investment, which I think is proving to be very popular at the moment. So I think that's the end of our slides on this one, Rich.
Great. Okay. Well, thank you very much to Frank and Lara for sharing about what is quite an incredible asset class. What I'd like to do is encourage people to put their questions into the chat box at the bottom right-hand corner. So you should be able to see a chat box. If you'd like to put some questions in there, we'll do our best to answer. one thing I'd also like to highlight in this particular investment is not only is it, from a commercial point of view, a great investment opportunity, as we've mentioned several times, low risk, high yielding, inflation hedging. But if you think about it, there is this chronic undersupply of social housing for people who have fallen on hard times. And as an investor, not only are you effectively, getting a great investment, but from a social point of view, you're actually helping to put a roof over somebody's head and give them a home, or their family a home, who may literally be, living rough or on the streets in, the worst case scenario. So there is a real moral and ethical side of this, which hopefully, makes you feel good, but more than just that, is actually really contributing to a real problem in society of people potentially being homeless. So there is a greater angle than just purely a bottom line investment. You are really helping an individual family to be able to live in, as you can see, a brand newly renovated home. Now I can see questions are starting to roll in, which is great. So I haven't vetted the questions, but I'm going to start reading through. I hope I can do justice to them. I might need some additional clarification, but thank you, Joe, for your first question. My main concern is the sale of the property compared to a typical residential property rented out as to a private tenant. Mm-hmm. How much more difficult would it be to sell the social housing property? A follow-up, let's start with that one. So maybe, Frank, if you can help with that one.
Yeah. So the lease is completely transferable in anybody's name. So the lease is currently in our name. The lease will be transferred to a new owner from day one with a fresh lease. And the property is valued on the strength of its covenant. So I use this example quite frequently because we've become pretty knowledgeable on what we think these types of covenants will trade for with private equity companies. So if we were to build out a complex in the north of England and apply a 10-year NHS lease, which is the National Health Service, we know that a private equity company would buy that at about 3.5% net yield because of the strength of the covenant. If it was an Amazon, a McDonald's, a Costa Coffee, a Starbucks, we know that they trade at about 7.58% on a commercial valuation. On a social and affordable housing lease, we know that these trade at about 6% because of the strength of the covenant. So whenever we're selling these properties, we understand that the secondary market isn't necessarily an exit to a owner-occupier because these properties are being specifically refurbished for the tenants who may inhabit them. So these properties are traded between investors. It's something that we've already done 16 times this year, is apply a new lease for somebody else and trade it between investors. Everybody wants to know fundamentally the strength of their investment always actually comes in the exit. You can enjoy as much cash flow as you like, but if you're stuck with an asset that you can't get out of, what good is that investment? Because we may need, for whatever reasons in our own personal lives, we might need that money back. What we've done for multiple investors this year is apply a new lease onto that property and trade it to another one of our investors. So the secondary exit is primarily to another investor. So the exit will be with a new lease to another individual looking to purchase this type of property. And that might seem like a risk, but what we've actually done, and a lot of our properties will actually put like a 10-year letter of intent to purchase the property back in the same value that you purchased it at. And we've done that multiple times already. So, yeah.
Okay, thanks, Frank. As a follow-up to that question, Joe's asking, in the event of a forced sale of a normal residential property, one might have to reduce the sale price to ensure a quick sale or to be able to sell it. Would the same apply to a forced sale for a social housing unit?
To say, so the lease is no break clause on either side of the contract. So the housing association can't break the contract with you, and you can't break the housing association contract with them, which ensures a very strong covenant, which is how we get the valuation. So to ensure a quick sale, obviously a lesser price is obviously going to inquire more people, because if you reduce your price on the current rent levels, the new individual who's purchasing it will be getting a higher yield. anything at 10, 11% net yields is going to sell quicker than something at 7 or 8. But we feel like 8, 9% is the same sweet spot that everybody's interested in purchasing at the moment. So to the answer to that question, in obvious terms, yes, if you reduce the price, it's more likely to sell. But all of the investments that we're selling at the moment are all going at 8 and 9%.
Great. Next question. Which party takes care of the ongoing maintenance, wear and tear, etc.?
The housing association, the person who has the lease. So they're claiming rent, they're claiming housing benefit from local councils, and they use a particular margin for the operational wear and tear. So they move in tenants, they move them out, they run their operational staff from there. And an FRI lease means that's inside and outside the house. So that's anything that may be incurred damages from the tenant is covered under that FRI lease with the person who's holding the lease, which is the housing association.
Great stuff. I mean, I think really to expand on that from what we've said in the presentation already, when we're talking about net yields, these are truly net yields. There are no void periods. There's no repair and maintenance costs. There's no management fee. So the housing association takes care of putting the people into the property, managing it on a day-to-day basis, taking care of the repair and maintenance. So from that perspective, it really is a very much a hands-free investment. You're not having to get bogged down compared with a private ownership property where a property management company might be liaising with you, asking about, are you okay with this cost of repair and maintenance, having to replace the tenant every so often. So, you know, you don't have those headaches with these kind of properties.
Well, one thing I would add on to that, Richard, is, you know, if you look at what I'll say, quote unquote, smart money, which is institutional private equity, people who have far larger due diligence teams than we do, the largest sectors in the UK economy of property purchases are all with commercial leases, whether that's in leisure, industrial, commercial. It's a very competitive landscape to get in because the power of an FRI lease means you, Richard, could be in Singapore, Geneva, wherever you may be, and you know that you're not going to get a call at 2 o'clock in the morning, 7 o'clock in the afternoon, whenever you are, everybody's got busy lives, and say the tenant has come back and kicked the doors, or the tenant hasn't paid their rent, or this or that. A commercial lease means you have that comfort, that sweet, that peace of mind to know that it's all taken care of for you. So I really think what's interesting about this sector is it opens it up to a larger demographic investors because commercial investment is so competitive in the UK and so dominated by large institutional funds. This is buying a normal residential asset, but with a commercial lease. And hence why I think it gives an investor accessibility. It reduces the barriers to entry that are typically afforded for larger private equity companies, but it has all the benefits for why they're actually purchasing that type of property.
Great, thanks. Next question. Are all the properties based in the northeast of England?
So originally when the company was started, both me and my business partner are from Yorkshire. We're from Leeds, West Yorkshire. And where we've seen property prices move, as Richard quite clearly pointed out, you know, in the last 3 years, we've seen a huge property increase in the value. So where we wanted to be 7% net, we were being squeezed down because all of our rent calculations are based on local housing authority rates, where we're able to achieve a certain rent based on what the council are prepared to pay. So if we were actually to translate that into property values and where they've increased the most, we've actually been squeezed out of a lot of areas. Whereas in the northeast, our entry values are still moderately low, you know, compared to the rest of the country. But the rent that we're able to achieve there is actually the same as what we're able to achieve in West Yorkshire. So to start with, we were working on the Mears and Serco immigration contracts. Then we won a northeast contract where we increased our rent significantly. So we moved our yield from 7 to 9%. And that was only really done in the last 6 months or so, where we're actually achieving 9% across the board on all of our new properties. So the reason that we target the northeast is singly because that's where we can achieve the best yields.
Great. Can the property be bought in my own personal name?
Yes.
It can also be registered and bought through a company structure as well. Is that correct, Frank?
Yep. Yeah, there's a company that you and I both know, Get Ground. You can set up a limited company structure in the UK. One thing that I will add is because the rent is deriving from central government and it is a regulated entity, you will need a UK bank account in order to receive rent. That's the one caveat with this investment, is you will need a UK-based bank account to receive rent, because a housing association that's regulated from, you know, big housing association regulation can't necessarily send funds overseas. So that's one thing that's duly noted that needs to be set up prior to investment.
And just so you know, even though it's not the easiest thing to set up a bank account if you're non-resident, if you do buy it through GetGround to a company structure, actually GetGround will set up a bank account for you. So that's one of the many benefits. HSBC tends to be a little bit easier, especially if you already bank with them out here in Asia as well. But again, we can help you with that should you want to pursue this a bit further. So common question, next one is, can I get a mortgage on this investment?
So across the board, they're all cash investments, and that's done for a couple of reasons. One is, once we've identified a property, the demand at the moment is, without trying to over-egg it, is very significant. So once we've identified a property, the cash purchases take 2 to 4 weeks to complete, and a housing association meets some of the supply balances that they're actually struggling with. Another one is a housing association doesn't want to have a concern where if an individual were to run into financial difficulties in their own predicament, that for whatever reason the bank would repossess that home, and then whatever happens to that property, it could change ownership, the status of the property could change. So from a housing association regulatory perspective, they would prefer it to be owned outright, so that there's no fluctuations in interest rates and the possibility of that property running into probate. So at the moment, they're all cash purchases. You'll see that some of the values sub 100,000, it's actually quite difficult for an overseas investor to get a mortgage on anything sub 100,000 anyway, without it being quite a high interest rate. But at the moment, they're all cash investments for the reasons singularly to do with the housing association, just because we have a great relationship with them. They've never defaulted on a rent payment in the last 4 years. They've never missed a rent payment in any of the stuff that they've done with private equity companies. I would add that our housing association partners facilitated over £350 million worth of total revenue in terms of the profit that they've created, in terms of the property splits that they've done to some of the largest REITs and private equity companies. And all of those have been cash. So at the moment it is a cash investment, yeah.
I mean, Frank, to add to that, I have heard that if buying a larger portfolio, and when I mean about a larger portfolio, it could be like £2 million worth upwards. In the past, there have been people that would lend against a portfolio. So for the larger portfolios, there may be some opportunities, but for the individual units, as we've been speaking about, between 80,000 to maybe 160, 70,000, they would be cash purchases.
Yeah, certainly on the larger portfolios, then there's different ways of getting commercial valuations based on like gross rent multipliers and whatnot. But typically on the lower purchases, they are cash just because of the entry values as well, and what actually a bank is prepared to lend on those lower valuations.
Next question. How is the income classified by HMRC? Is it effectively like an HMO, or how would the...
It's just rental income. It's how you would classify it. It's when you're doing your self-assessment individual tax return. As a UK citizen, you've got £11,000–12,000 tax-free threshold, but it still comes under just rent generated from a property.
Okay. Hasnain's asked, what about the rates? Who pays these? So like, things like council tax and those kind of things.
All paid for by the housing association.
Okay. Where can I get information on the sizes of the unit? Well, I can share those with you. So after the event, please do reach out to me. I'm more than happy to have a conversation or a call or meet up with anybody who's on the call tonight. And I can go into much more detail about the units, what's available. We did show on one of the earlier slides a snapshot of some of the units that are available. Because of the popularity of this investment class, they do tend to go very quickly. But fortunately, Yield Invest have got a good pipeline of product coming through. So there's typically something to meet most people's budgets.
I would say that availability is very fluid and it moves quite a lot. At the moment, we're doing anywhere from 20 to 25 houses a month. And we're increasing our development capability because we've got basically an agreement for lease to do another 500 units over the next 2 to 3 years. But at the moment, we're selling quite a few every month, so it's quite a fluid availability. But typically, a 2-bedroom will be around 116, a 3-bedroom around 140 to 150, and a 4-bedroom around 180.
Okay. How is your company involved after the sale of the property to the individual? So, is Yield Invest have any involvement after the sales and purchase agreement is signed and it's all been rented out?
Yeah, we're the direct liaison for you between the housing association. So anything that you need, whether it's chasing a rent payment, which has actually never been needed, but anything that you need just to speak to the housing association, if you want to check up on the property, if you want anything, we offer a full-time liaison between the two. So we're basically the person in between applying the leases, completely developing the property, and handling the investment process for the investor themselves as well.
Great. Curtis is asking, is the housing association in the UK a GLC, a private entity, profit orientated?
So there's two types of housing association. There's non-profit and there are for-profit. For-profit is a very new thing, but the housing associations that we work with are non-for-profit. We also work with things that are called community benefit societies, which are regulated entities, and community interest companies, which are CICs, which are charities as well. So we work with, a host and group, a whole different group of entities. If you look at Mears and Serco, they are very much for-profit. Mears is owned by a very large company in America. Serco is a listed company on the UK Stock Exchange. But housing associations tend to be non-for-profit. So they're not looking for incredible margins. They're just looking to house vulnerable tenants as part of their process. Thanks.
Hasnain, I'm not quite sure. You mentioned that British national. What about those who are not?
I think he's probably, if you're a British national overseas, what tax position have you be? And again, it's probably very, very dependent on where you're situated and what nationality you are. But if you're setting up a UK limited company to purchase a property, you're just going to be liable for UK corporation tax, which is what, 19%, 20%.
Yeah. Yeah. Okay. Any more questions? Appreciate those of you who've already put the question into the chat box. If you come in a bit late and have a question, please do put it into the chat box. I'm conscious of time. We are almost at 9 o'clock. Now, the last slide you can see, obviously, is my name and contact details. And I would like to encourage any of you to reach out to me. Please give me a WhatsApp or an email if you'd like to have more information. I can send an information pack with some examples of the different properties we have, whether those are individual units or some of the block purchases as well. So, I'm based in Singapore, so you can probably see from my email address and telephone number. So, I'd be more than happy to have the follow-ups after this event. Oh, we do have another question just come in. Is there another avenue of secondary sale, not through your company?
Well, there's not going to be a owner-occupier. One thing that we are very cognizant of the fact is that because we're selling such a vast number at the moment, that there could be a possibility for us to aggregate all of our existing investors into a larger portfolio deal and give them significant uplift on the sale, which is something that we're looking to structure in the future. But if you have somebody that wants to purchase the property from yourself, that's absolutely fine. You can just transfer the lease and ownership and we'll arrange that for you as well. But if you want somebody to sell it and you don't have somebody to sell it to, then that's singularly what we do as well. So it is going to be to another entity that are looking for investment. It's not going to be for somebody who wants to live in the property.
Yeah, I mean, at the end of the day, you can leverage off Yield Invest, myself. You could list it and sell it. And, if you're listing it, who knows, if it's starting at 8-9% yield in a few years' time, that could easily be 10, 11, 12%. And that would, be a very attractive acquisition for another investor. So I see no reason why, if you're providing a very attractive yield, that you won't have many, many people wishing to buy. I mean, we're certainly seeing the turnover of the properties that Yield Invest move very quickly, again, because of the investment case that we've presented tonight. Okay, all right. I don't see any other questions coming in unless there is anyone who's been shy and hasn't put their question in. But again, I'd like to thank Frank and Lara for joining us tonight and sharing about this. I say unique, it may be very new to a lot of people, but actually social housing has been around for decades. It's just that yield investing are really now packaging this for a retail investor as well as an institutional investor into a very sort of turnkey package that makes for a very easy, hands-off, low-risk, high-yielding investment. So unless there are any other questions, thank you very, very much for your attendance tonight. And again, please don't hesitate to contact me on my contact details, and I'll be delighted to help. So thank you very much and good night.
Cheers, guys.
Thank you.